my business partner and I, when we kind of looked at the world and discussed this situation, I told him, I said, my number one goal here is to avoid a capital call.
Love it.
That's the number one thing. So if we have to pause now and look like the bad guys now, that's okay, because it's well worth it to avoid a capital call in the future.
Ladies and gentlemen, welcome to Real Estate Investor MBA. My name is Tejas Gosai, and I've had the honor of helping hundreds of investors achieve the American dream by creating generational wealth through real estate. I've spent the past few years interviewing the most knowledgeable experts I could find in the business to cut your learning time and conquer the hardest subjects in the game. Check out rei.mba, which my team and I have packed with over 75 interviews and free access to our real estate roadmap, webinars, and publications. If you're listening, I am rooting for you, and you're already on your way to financial freedom. Cheers and happy hunting. Underwriting is everything. I have been underwriting for decades now, and when you can master the underwriting process, you will conquer the real estate business. Everything is in the data, the facts, the science, the demographics, the statistics. And if you can analyze all of that the right way, you are making a calculated risk. And you're limiting that risk by ensuring that you have the facts and figures to make an educated investment. Rob Beardsley, our guest today, is the man when it comes to underwriting. And it's exciting to have somebody on this show specifically for this topic, because you can see exactly why it is that important. This guy's had some tremendous success, and you can see it in the calmness of his voice. He knows his stuff. It's inspiring. So let me tell you about Rob. Rob oversees acquisitions and capital markets for the firm that he helped create and has acquired over $350 million of multifamily real estate. He has evaluated thousands of opportunities using proprietary underwriting models and published the #1 book on multifamily underwriting, The Definitive Guide to Underwriting Multifamily Acquisitions. He has written over 50 articles about underwriting, deal structures, and capital markets, and hosts the Capital Spotlight podcast, which is focused on interviewing institutional investors. Please enjoy the interview. Check us out on iTunes, Spotify, Stitcher, Google Play. Our website is rei.mba. We have a roadmap and a bunch of tools to help you on your journey. Cheers, guys. Hey, guys. It's Tejas Gosai. We have Rob Beardsley with us today. I just gave a long-winded intro. Rob, welcome.
Thanks for having me on the show.
For sure. Give us a high-level introduction to you. Tell me about what you're doing right now, and let's catch up.
Sure. Sounds good. Well, my name is Rob Beardsley. I'm the founder of Lone Star Capital. My business partner and I, we started our company about 5 years ago to focus on owning and operating Texas workforce housing. And to date, we've acquired over $350 million in multifamily assets, primarily in Houston. And Houston is also where we launched our in-house property management firm. So we've been focusing on vertically integrating, building out the portfolio, and implementing our value add strategy.
Your resume is definitely stacked. It's sometimes nice for listeners to hear how you went from where you were to catching that steam. Can you share some of the beginning? I mean, those are some big numbers, but you didn't start out that way, right?
No, of course. So like I said, we started about 5 years ago. And when my business partner and I, we first connected, we actually met through a mastermind group, and we met at a conference, which was quite interesting and unique. Myself, I was in college still, and he was working a day job as a tax attorney. And we both kind of wanted to do something entrepreneurial, and we felt that multifamily was a very big opportunity. And so we leaned on each other to take that leap of faith. And we started off pretty ambitiously with our first deal being a nearly $20 million project in Houston. So
When
yeah,
was that? How long ago?
We acquired that property in, I believe, July of 2018.
So that's a pretty big first win. How long did it take you to do that, going from here to there, finding folks, fundraising?
It took a long time. It was very difficult. We underestimated the difficulty of doing a deal, right? There was just so much that we didn't know, which our naiveness allowed us to have the confidence to dive in and just go with the flow and learn as we go. But yeah, there was a lot that we didn't know. We made plenty of mistakes, and I think the biggest thing was just the underestimation of how difficult it is to raise capital.
Yeah. I agree. I manage a fund. I went from commercial real estate agent to being in charge of a fund. The hardest thing I've ever had to do in my life. Thank you for talking about it.
Yeah, exactly. So we neither myself nor my business partner came into the business thinking that a big focus of either of ours would be raising capital. That was kind of just a annoyance, a nuisance to deal with in the pursuit of deal making and building up a portfolio and running a real estate business, right? Little did we know, raising capital would have to become center point, a very integral part of what we do and focus and make sure that really truly investor relations and relationships are the most important thing in the business.
Yeah. It's nice to hear you say that. I think in our business, even just in real estate, it's like, hey, we got to get the money. We got to do this. We got to do this. But you are helping people. And, fast forward, you have helped, I don't know, tens of thousands of people with how many folks you've housed and how many investors have been able to take advantage of your opportunities. When you got over that hurdle, how was it to have your first, batch of investors and kind of develop that relationship?
It was great. And again, a lot of learning there. And I think you learn the most when you take outside capital. I hear a lot of people tell me that they're looking to get started and their game plan is to learn with their own money first. And they say, well, I need to do a deal, maybe a smaller deal with my own money first before I take investor capital. That makes sense. And that's a logical approach, but there's no substitute for taking investor money because the second you take outside capital, everything becomes so much more serious and you
You're on
have
the
to be
hook.
you're on the hook, you're held to higher standards. If it's your money, you can be lazy. You don't have to produce good monthly reports and quarterly reports and communications and things like that. So
Yeah, it keeps you up at night. Let's just say it, right? Like when you work with other people's money, you really want to look yourself in the face, be a strong fiduciary. And I'm so happy you're saying that because that is what people think. Like, let me get this 2 unit, 4 unit. You may lose 5 years in that process. Keep going. Love it.
yeah, no, you're exactly right, right? And if you do the 2 unit, the 4 unit on your own, not only are you not necessarily losing 5 years, but you're missing out. You're not actually getting the
Handicap.
crucial experience.
Yeah.
Yeah.
Thanks for sharing that. So let me keep following the story. You obviously cultivated this great relationship and then investors turned into other investors. You start showing returns. Tell me about that part of it, like when you got to your next project and, scaling it up.
Well, it definitely took time, and it makes sense. This is a slow moving business where you don't necessarily have a track record in a day or 6 months or even a year. It takes years to build a track record. So we're still in the process. I mean, our track record is nascent still, but it has been some time to where we've worked with investors. They've gotten to know us. They've trusted us. We've produced results, and that makes a world of difference. If you're talking about the difficulty of raising money, yeah, raising money without a track record is really, really tough. On the bright side, it only gets easier, right? As you have more experience, as you build up better relationships and more of a track record, it only gets easier. So that's something that motivates me and that I look forward to. I just love the concept of compounding the growth and that things will start rolling downhill. Things have already started to get a little bit easier, but I still feel like, it's hard work, but I think that results will start to come at a faster pace.
Having a perfect record is super hard. You have to take risks in your business and you mitigate those risks and you tell investors about that. And that's how you get to the next projects. Tell me about some of your, like after your first one, how was your fifth, sixth? Like by that point, it had probably been a couple years. How was it before COVID hit?
Well, before COVID hit, we actually had done a couple deals with a couple institutional partners, so larger larger checks, funds or private equity firms, and that was the direction that we were strongly leaning in, and that was working well. But when COVID hit, obviously there was a lot of uncertainty, and everyone was kind of freaking out and pencils down and didn't know what to do. So unfortunately, right around when COVID hit, we had to drop deals that were under contract, and we took a very big pause. And looking back on it, obviously hindsight is 2020. That was a mistake because everyone was essentially wrong about the economic dynamics associated with COVID. Everything really worked out. Interest rates went to 0, and performance was fine at the assets, and property values skyrocketed. So it would have been a fantastic time to buy, but unfortunately, we sat on our hands due to
Prudency, man. You didn't want to take a risk.
you could say that, you could say that. We also just didn't feel like we had confidence in going to our investors and saying, "Hey, let's do this deal and let's raise money right now."
Thanks for sharing that. COVID was weird. I'm happy you said you took a pause. I think everybody kind of did. I do think a lot of people are hindsight. I wish I, spent a bunch of money, but you came out of COVID and, your trajectory has been pretty much straight up. So fill me in coming out of COVID. I know you've been super busy, much larger projects, much bigger investments. Fill me in from there to now.
Yeah, coming out of COVID, really 2021 to early 2022 was a very busy time for us just because the market was, like you said, a lot of people paused in 2020. So there was this buildup of activity. Due to the inactivity of 2020, everyone was ready to rock and roll, ready to buy and sell in 2021. So it was a very busy time. A lot of deals were transacting. So we made the most of it, made the most of the capital markets where cheap debt was available. And yeah, like you said, we scaled a lot very quickly. And at the same time, more time had passed, and it allowed us more time to build relationships with our investors, make new relationships, and like we've been discussing, the practice of raising capital just got easier and easier and smoother, and we started to find new partners and new avenues to raise larger sums. So that was very big for us, and we're now sitting in early 2023 and looking to continue to build off of that momentum in spite of current market conditions.
Yeah, thank you for getting right to that. So current market conditions, you're scaling up. A lot of people are mentioning dry powder and just waiting to go smack the market. Do you feel that way? What are you preparing for? Can you give me some crystal ball stuff?
The market right now has been categorized by an unprecedented and non-consensus rise in interest rates. And when I say non-consensus, I just mean the market didn't expect it. It wouldn't be so impactful if everyone had been expecting the rise in interest rates, but it came so unexpectedly that it really turned the market upside down for a while and made transactions nearly impossible because sellers have expectations and have maintained expectations of certain prices based on yesterday's market dynamics, but buyers are forward looking and they're looking at the future. They're looking at the interest rates that they have to use in order to acquire property, and there's just a disconnect there. So that's made transacting kind of in the back half of 2022 very difficult. So we've seen, and actually the roughly speaking, the year over year transaction activity is down 75%.
I didn't even know that. Can you tell
Yeah.
me more about that?
I forget when I think that statistic was in maybe October-ish, but if you just say December, basically, definitely the last 6 months of 2022 compared to the last 6 months of 2021, at least a 75% decline. Yeah, I mean, it went from brokers getting lazy and having such an easy time to sell that they didn't even wanna go through the process of listing deals. They would just kind of slam deals together off market and move on to the next. And now we're in a situation where brokers are following up with you and trying to make a deal happen because they just don't have as much going on. It's just harder to make a deal work. So that's what the market's been like. Just to put some numbers to it, or make more sense of why, we were all underwriting deals with interest rates in the threes. And also, if you were borrowing floating rate debt, the forward curve was projecting to stay, essentially below 1% for the next couple of years. So you were underwriting based on the forward curve with low rates to stay for the next 2, 3 years. Fast forward to today, we're looking at interest rates in the fives and the sixes. And if you're borrowing bridge, it could be in the sevens and eights and the nines. I mean, it's just ridiculous the way that rates have blown out. And something that I do want to touch on next is that disparity between permanent debt and bridge debt. So we'll get to that in a second, but just focusing on overall interest rates, right? If you were previously underwriting a deal with 3.5% debt and now you're looking at 5.5% debt, something has to give. Either you're going to give on your return expectations, meaning you're willing to accept lower returns, and so therefore you can pay the same price, or the seller's going to have to give on their price so that you can get back to your similar return expectations. So now that's the tug of war in the market right now.
And it's a great tug of war. We've kind of been waiting for it, right? How are you communicating with your investors right now about the future? Are you, how are your returns? Have you taken a pause at all? I know some funds are producing differently right now.
Yeah, so depending on the financing of the asset, we have to reduce or pause distributions. The point there as well, when I say it really is related to financing, is the fact that operationally, pretty much every property across the board, not just in our portfolio, but across the market, is performing super well. There's some markets that got a little overheated, so now they're coming down a bit. But all in all, the market is extremely healthy from an operational standpoint. So NOIs are great. All the problems that are happening are on the debt side. And that's, certainly the case with our portfolio where we've seen interest costs, double and triple, and that's caused a reduction in cash flow. Also, there to get a little more nuanced and complicated, even if you have an interest rate hedge, so if you have protection on your debt, such as an interest rate cap, which puts a ceiling on your interest rate exposure, that doesn't put you in the clear because while your monthly interest rate may be capped and protected, you have to look out into the future and say, and see when does your current interest rate cap expire and what are the implications of that expiration and what is the cost of putting on a new hedge, because hedging is not free, right? It's very expensive to protect against rising interest rates. So and if the lender mandates your purchasing of a replacement cap, that could be $1 million cap
Astronomical.
when you originally underwrote the cap to only be $50,000. So that's a very difficult reality to deal with. And the prudent thing to do simply there, unfortunately, is to pause distributions. Because if you continue to go out paying distributions and then you show up at that expiration date and your pockets are empty and the lender needs $1 million for you to buy a new hedge, there's going to be a capital call. So it's good to look out ahead and do things early. And these are some interesting conversations that we've been having across the market with our investors and with other sponsors, talking about pausing distributions, which is a very big deal and it's a very negative thing to have to deal with your investors. If you pause distributions, be prepared to have many long conversations with your investors, right? And
Yeah.
rightfully so. You need to explain.
What are you doing? I thought you were the best. The market's
Exactly.
fine.
Exactly, right? Or better yet, why are you pausing distributions? I invested in another deal and they're
And
not
they're
pausing
paying.
distributions. They're
Yeah,
paying,
right.
right? So, and that's a conversation where you might look bad pausing early, but that might be the right move because the sponsor that pauses too late might end up going to have to deal with an even worse situation, which is a capital call. And that's the number one thing that we're trying to avoid. Make no mistake, what we're going through, depending on, types of deals you've done, but particularly if you've had floating rate debt acquired with in the last couple of years, this is a very big deal and a tough time to deal with. And so my business partner and I, when we kind of looked at the world and discussed this situation, I told him, I said, my number one goal here is to avoid a capital call.
Love it.
That's
Love
the
it.
number one thing. So if we have to pause now and look like the bad guys now, that's okay because it's well worth it to avoid a capital call in the future.
Brilliant, man. I love how eloquently you are explaining this. Some of our folks are first time listeners. Some of them are just people that I've been talking to, and I'm like, you got to do it this year. You got to do it this year, man. Like, look what this other guy did on this podcast. We had somebody from London in COVID that ended up, their first deal was 90 units in the United States they never visited. Like, there's all these crazy opportunities, but you have very difficult decisions and choices. And I think you'll agree with me. It's not fun to be a fund manager all the time. It's very difficult work. Like what you're talking about is predicting the future, right? That's a weird thing to say you're good at, but just looking at your website, looking at how well you've grown, it's interesting that you've stuck in a couple different just one market, right?
For the most part, yeah. Now we've expanded into Dallas, and yeah, focus is a very big key to our strategy.
I think that's one, correct me if I'm wrong, that's one of your biggest keys to success is that you've
Yes.
saturated and vertically integrated. Can you talk about that and kinda how you did it?
Finding ourselves in Houston was somewhat luck. We knew that we wanted to be in Texas because we like Texas and the fundamentals. It's a big market, a lot of opportunity to invest across the major markets of Texas and the secondary market. However, when we first were looking at deals, we felt that we found better valuations, better opportunity in Houston for whatever reason. And so once we acquired our first deal in Houston, then that led to acquiring our second. And then we felt that, well, we're really going to grow the fastest and get the best momentum if we continue this path of focus, because it really does take a lot of time and effort to build up the relationships, to source good deal flow, and the expertise to be able to underwrite that deal flow. And so if you have deals coming at you from all different angles, it's harder to really know what's up or down if you're not really a market expert. And then, you can't even expect to get good deal flow to begin with if you're not a known
Buyer.
player in the
Yeah.
market, right? With a good reputation. So once you've transacted with a few groups and you've done what you said you were going to do, that's going to make getting new deals and off market deals and first looks and last looks easier. So focus is big on the acquisition side, but then as you mentioned, focus is also big on the operations side, because if you own deals all across the country, vertically integrating is extremely challenging. You can't be sending your team on planes everywhere. So the fact that most of our portfolio today is in Houston, it made it much easier for us to actually build out the infrastructure and team locally in Houston to be able to manage the portfolio internally, which is very big for us. We feel strongly about vertical integration and managing in-house, just for greater control and transparency. And our investors agree. It's definitely, I would say, one of the keys to actually scaling and raising more money is being vertically integrated.
Love it, love it, and it's not easy. How long did it take you to kinda get that wrapped up?
Yeah, we worked on that transition for a couple years, and we finally made it happen in the summer of 21. And I think we did that at about 800 units. And today we have about 2,500 units, and we still lose money every month on the management company. And that's just the reality of management. That 3% management fee that you collect off of revenue is really small. And if you staff your team uh, such that you want to make the properties perform optimally, you're going to have to bear greater costs on the management side. But it's all for a greater good, right? Because where you really make the money is being successful on the deal itself, not trying to peel off as much fees as possible.
Yeah, that's a nice way to put it. We use a third-party property management company. Hopefully one day we can in-house. Tell me about that. So, it's gotta be a lot to run that many units. It's not necessarily about the fee part of it, but you have to have a pretty organized. I don't know how many people you have, if you could share any of that. Takes a lot for rent collections and whatnot.
Right. Well, regardless of whether you have in-house management or third party, if your property is, usually maybe 50 or 80 units or greater, you're going to have on-site staff. And so all of our properties have on-site staff ranging from a property manager, assistant manager, leasing agents, and then maintenance teams. So the on-site staffs at the properties take care of the on-site responsibilities, like you said, like collecting rent, like doing maintenance requests. But then those teams need to be managed, and those teams are managed by regional managers. So we have two regional managers that oversee the portfolio and a VP of operations that oversees those regionals. So that's kind of the hierarchy and the the structure with which we feel confident in scaling, because as you add more properties, you add more regionals, and you kind of just grow from there. And then you add other things too. For example, we just brought on a construction manager onto the team, regional maintenance director. So you scale up and you grow. And for us, we're looking at how much revenue the management company is pulling in through that 3% management fee. And we're saying, okay, who can we hire and how can we continue to add value to the management side of things based on how much money we're pulling in. I mean, we were willing to break even or lose a bit of money on the management, but obviously within reason. So we need to see how much is money's coming in, and then what kind of payroll can we afford.
Very hedging in great ways. Motivation stuff. I'm sorry, we're coming to time soon, but you work 24 hours a day. How do you take it easy? Family, kids, friends? Tell me about how you stay so in line.
Well, I have a very simple life. I'm turning 26 in less than a month. I'm single. I
Not
live
for long.
not for long. I live alone. So I keep things pretty simple. We're here in the office. We're building a fantastic team. We all get along. We all work well together, and that's kind of my one of my biggest motivations is just building something larger than me, because I am, and maybe this goes back to my parents, but I'm very fearful in of building a job, right? I don't wanna build a job, I wanna build a business, and growing up, I saw my parents run a residential brokerage firm, and they didn't really have they only had really 1 or 2 employees, and it was just a job. It was just very tough. They worked so hard, and, that didn't resonate with me. Obviously, I want a bigger vision, I wanna build something, and what that requires is a big goals and big numbers, because it's a lot easier to recruit people and get people to buy into our vision if we have a moonshot. If we just say, hey, we're just going to do a couple little deals, do you want to join the team? That's not exciting, but we can definitely grow a big team and make our lives easier actually by having bigger goals. So that's kind of my motivation and view on growth.
I love that. Routine, consistency, like morning time. I think most productive people have like a very serious schedule. I got to ask you, when do you wake up in the morning?
I'd say around 8 o'clock.
And you work late or
Sometimes, yeah. I mean, I kind of work when I feel like it to an extent. Obviously, during the day, there's phone calls, but so what I like to do is I like to sleep in. Obviously, wake up at 8:30, and would love to go to the gym before work. That would be awesome, but I would rather sleep in. So I sleep in, meditate in the morning, drink some tea, this and that, and go to work, and then usually I'll work out at 6 o'clock in the afternoon. So that's a nice kind of break in the day where I can go work out in the afternoon. And then if I have something going on, maybe after working out, I have some social stuff like going to dinner or drinks or something like that. But if there's nothing going on like that, then I might get back home and go to my desk at home and work from 8 to midnight or something like that.
love it, man. Thanks for sharing all that stuff for those listening. I don't mean this like in a weird way. You're younger. I'm in my 40s. I love 20-year-olds that are just crushing the universe. It's my favorite thing. I think, mentorship is a big thing. And you said you met your partner at a master class. Can you share like how you met them and kind of give some encouragement to people to go outside and meet someone?
Yeah, yeah. I mean, it was very serendipitous, but we both were in Joe Fairless's mentorship program, which had awesome people in it. When I joined, and then I'm sure it's only gotten better. And so we were both in that group. He is 17 years older, so we were kind of in different phases, but similar enough because I was in college and he was at his, he was a tax attorney. So both of us wanted to. I didn't necessarily want to drop out, but I wanted to do something, and I was really excited about this opportunity. And he was kind of more so looking to leave his job. So, like I said earlier, uh, when we met, it was very organic, and we didn't have this master plan from day one. We just said, all right, well, let's just stay on the phone. Let's keep in touch. Let's talk deals. And we were on the phone every night, and we were looking at deals together. And then just slowly but surely, we got to a point where we put our first deal under contract. And then once that happened, we thought, you know what? Let's make this more serious.
And that was 2018 to now.
Yeah.
I love it. Last thing. Yeah, I like to end on a really high note. People think real estate, you're just money grabbing or fundraising, millions of dollars. I do like to say we're helping a lot of people, creating suitable housing, making sure that everyone has a roof over their head. You mentioned workforce housing and, helping with the crisis in that part of the world. What does that mean, and why is that your mission?
Well, something that we're working on and really excited about is an affordable housing strategy where we have a partnership, the housing authorities down in Texas, and we actually place rent restrictions and income restrictions on our properties, so we can cater towards households that make less than the area median income. I love that for so many reasons. Selfishly, it's a very nice defensive strategy where I don't have to bank on renovations and big rent increases to earn great returns. I can kind of more so stabilize the property. So, that's obviously a win for us. And then it's a win for the tenants, of course, because they have an opportunity to housing that they otherwise wouldn't.
It's awesome, man. Great mission. Sucks we're coming to time. How does somebody invest with you or contact you?
Yeah, to learn more about what we're doing at Lone Star Capital, you can go to our website, lscre.com. So, yeah, feel free to check us out there. And if you want to get in touch with me, you can connect with me on LinkedIn. I post daily on LinkedIn and, chat, you can message me there.
Love it, love it. Very cool. Thank you for being on the show. I can't wait to follow up next year when you're at like a billion, hopefully. Right?
Hopefully.
But no, amazing. Thanks so much, Rob, for being here.
My pleasure.
Tejas Gosai, Real Estate Investor MBA, reimba.com, iTunes, Spotify, Stitcher, all that fun stuff. We love you guys. Cheers.